We are Group 3. We're happy to be here with you today to discuss a hostile takeover bid for Walt Disney Corporation in the mid 1980s. So we all know Walt Disney Corporation as the company that produces iconic, lovable animated movies for us. Uh, the success that we see today is not as closely related to what was going on in the mid 80s. Really, they were going through a challenging time when analysts believed that splitting up the different uh, revenue streams into different companies and selling those off would potentially generate a greater value than the whole of the company that is Walt Disney Corporation, which led Saul Steinberg to offer to buy the company. And really, what had happened was the competitive advantage was not sustainable after new leaders in the wake of Walt Disney were unable to discover new growth sources. They had lost his foresight into Disney's assets and resources and activities to be successful, which led to Saul Steinberg to make this hostile takeover bid. So Disney's main sources of revenue, the revenue streams are split up into three areas: production studios, the attractions, and the merchandise. The film studios have these iconic characters, but no clear strategy to extract that value. They have this extensive library. They've made a move in 1983 to start Touchstone Pictures, which is a motion picture studio to cater to a more mature audience. Really, the studios had been stagnant since the mid to late 70s. The attractions like Disneyland and Disney World account for 79% of the revenue and 90% of the profits. The real threat there is that attendance is flat over the last few years. Merchandise is the things are the things like toys with these characters like Disney, like Mickey Mouse. They held 25% of the market share for specific categories of characters. The real threat here is this increased competition from cable channels, which are offering other characters as a substitute for Disney's characters. So really, in this situation, the amusement parks are the cash cow for the company and what is keeping Disney afloat. So let's take a quick look at their performance. They have steadily outperformed the S&P 500 all the way up until the late 70s, where they began to stagnate, culminating in 1983 when they had an earnings per share of $2.70, which was the lowest that it had been in 6 years. On the finance side, they always tended to be debt-free or close to it, at a coverage ratio of 11.6 in 1983, high cash flows, which leads analysts to believe that there's a lack of urgency reinvesting in the company, and leads to the thought that maybe they should split up these different segments. So is Disney a growth company? Well, we believe that if they can recapture some of the vision that Walt Disney had for the company, that yes, they can be a growth company, mainly because they exhibit or have the potential to exhibit again some of those tendencies that growth companies have, such as creating substantial cash flows, having an endless vision, ability to fund own capital-intensive projects, and then the ability, which we believe they will be able to do in the future, which is outperform competition in the stock market, which they had done up until the late 80s. So should they pay green mail to Steinberg? Well, Disney's culture, vision, and values will be jeopardized if they allow Steinberg to carry out his hostile takeover of the company, and they'll lose access potentially to those iconic characters, which are really the basic asset which they use to generate cash. So if Steinberg gains control of the company and sells off the film library, it will lead to a quality risk in the portfolio. So we do believe that they should offer to pay green mail and repurchase his shares so that they can re-envision themselves, go back to the fundamentals that Walt Disney instilled in the company, and be successful. This should look like the following. We would recommend repurchasing the shares at $72.50 per share, and believe through our analysis that would cause the stock price to increase to an equilibrium of $59.76 per share, which is a 14% increase. With that, we want to thank you for taking a few minutes with us this evening.